Fidelity just did the unthinkable. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, you're not going to believe what one fund manager at Fidelity just did, and we're going to put his decision to the test. And be sure to stay tuned to the end of the show, because we're going to have one slide that will make or break his decision, showing you if he did a smart move or if he did the worst possible thing for his investors. Now let's head over to Bloomberg, where we picked today's story up with a headline: Fidelity manager dumps nearly all treasuries on growth optimism. And this would make sense, because if indeed the global economy was resurging here, and this was just the beginning of a long growth cycle, then what you typically see is interest rates rise during these periods, because there's so many other investment opportunities that there's no need to go to the safety of treasuries. There will be other ways to earn interest. There will be other ways to grow your money that you would turn away from treasuries. In fact, what we tend to see is that during periods of economic growth, interest rates rise. So indeed, if that is the base case here, then this was a smart move. But if we're on the cusp of a recession or even worse, financial crisis, this is one of the worst moves this fund manager could make. And Singapore-based George Estopoulos, who helps manage about $3 billion of income and growth strategies of Fidelity, sold the bulk of his 10 and 30-year Treasury holdings back in December of last year. He's now turning to assets that typically do well in times of good economic growth to boost returns, which is notably equities here. And so what we're seeing is, again, a move that makes perfect sense if you believe the narrative that the global economy is at the beginning stages of an expansion, because what it suggests is that indeed interest rates here are only likely to go higher. And in that case, if you're a bond fund manager, or in this case, a fund manager, you want to get rid of that portfolio protection and seek other type of assets, particularly risk assets here. But as they started out the show with, if he's wrong, well, he made a really bad move. And we don't expect a sort of recession anymore, he said. The probability of a no landing is still small, but it's been increasing. And if that increases much more, potentially we will not be talking about Fed cuts anymore, suggesting that he's more concerned about Fed hikes going forward here, which would put upward pressure on yields. Now let's take a look at what he did here. We can see on this chart of 10-year treasuries, this is back here in December, where we can see he sold the bulk of his 10 and 30-year treasury note and bond holdings. And since then, this being yields on the 10-year, they've gone up a little bit. So on the onset, it appears that he made a really smart move. But the risk here is, if we see a big collapse in interest rates driven by a slowdown in the global economy, a global banking crisis, another financial crisis, then all of the insurance in this fund, well, he sold it all, putting his investors at risk in a big way. And he's among those cooling on treasuries as the U.S. economy's resilience forces investors to rethink bets on interest rate cuts. Some are going a step further, even speculating the Federal Reserve's next move, maybe even a hike, after the recent strong inflation and jobs reports, suggesting that perhaps indeed the Fed got this right. They tightened interest rates. They're holding them there because they know inflation is going to come back. Now, many of you in the comments say, look, Steve, you can't see it. Inflation is going to come back. We've made the case that is highly unlikely at this juncture, but there is the possibility something could happen, and that would be on the back of a very strong U.S. economy going forward here, not to mention a strong global economy. And this is something that could be led by the global equity markets. We see the U.S. equity indexes breaking to new highs. We see around the world, despite a slowing global economy, investors continue to pile into risk assets. So this could be the effect that Greenspan coined as a wealth effect, where as consumers and investors feel wealthier, they start spending into the real economy, and with a lag, it pulls the economy higher. If that's the case, then well, we could be talking about a surge higher in inflation. In that case, you would likely see interest rates go higher. But the issue is, why aren't they a whole lot higher now if that's the case? Because when we look at this chart here of Treasury yields on the 10-year in blue against the consumer price index in red, and what we see more in modern times here getting out of the 80s is that the bond market knows where inflation's going long before the Fed has ever figured it out. In fact, what we see is on the way down, we notice that yields start to fall even when inflation's rising because the bond market knows it's transitory and heading down. We can see as inflation rises, it does tend to push yields higher here, but as we look, the consumer price index doesn't give us any indicator that it's rising. In fact, it looks like it's about to head even lower. What's notable here is this is one of the first times you can see in the data where investors are so bearish on bonds and bullish on yields going higher that they're betting massively that interest rates have this priced wrong. They have to go higher. So normally when we see a decline in the consumer price index, it's not unusual to see a big decline in yields. We didn't see it this time. Does that mean that fund managers like the one here at Fidelity is right and that other investors are right, or that they're all wrong and about to find out in the worst possible way? Because when we look at non-farm payroll report against yields, well, we have no conclusive evidence here that there's any relationship. In fact, there's about virtually none if you could gather at that. Here we see the non-farm payrolls on a year-over-year rate of change, again suggesting not much of a relationship. So even if we continue to see hiring, that doesn't necessarily translate into economic growth. You can be replacing high-wage factory jobs with low-wage services jobs, and on net, you could see the economy slow down here. So if you're just looking at the payroll report and perhaps inflation, well, you're not getting the clear picture because the inflation report is telling us the demand continues to fall despite the fact that the Bureau of Labor Statistics continues to put up these outrageous numbers on their non-farm payroll report month after month. If there was all this pent-up demand from this labor market, then why aren't we seeing it in the data? That remains the question. But he sold his treasuries over concern over as U.S. growth faded. The asset is typically less attractive amid elevated borrowing costs, and when prices reflect the Fed's median forecast of 3/4 point interest rate cut this year, what he's suggesting by his decision is that's not going to be enough cuts to be worth my investment in holding it when there's other opportunities that he perceives are going to be far better for his investors. He sold bonds from other developed markets, including gilts and bonds, while leaving some exposure to inflation-linked U.S. government debt and an idiosyncratic position in Austrian bonds. Perhaps what he should have been doing is taking a look at our Momentum Time Pro report and our CTA Time Pro, because we'll give you some amazing signals. In fact, this weekend I put up another video. All week I put out videos on how to trade, what our reports are telling you, making this so easy. We want you to be successful. We want you to make money trading. I know many people struggle with that, but we give you some incredible setup opportunities. And now on first page on all reports, we give you the daily signals, the best of our best signals. This one from our Momentum Timer Pro report. It takes all those technical signals like the RSI and the MACD that cause people to get in too late and out too early. We smooth them out and we apply our proprietary signal that no one else is using. And here we can see back on January 25th, we went from a sell signal on the 1 month window in Momentum as a buy signal on China's large cap FXI ETF. And what do we see on our CTA Timer Pro? Now, no one else is doing what we're doing. Now, you see the machine positioning. There's a couple people, you can find some obscure reports on a couple things, but what we do is very unique. We put a historical overlay. So we tell you when the machines are extremely long or extremely short based on history, which tells you when they're mispositioned, when they're extremely short. That's when opportunity knocks, and we tell you when those position changes now on page 1, and we give you videos with it too. And how about this? Here we can see on January 26th, that was a Friday, FXI flipped, and we then on our Sunday show said, put a buy and open. Had you followed that trade, you'd be up 6.91%. No one says, hey, everyone's saying, avoid China. Well, if you would have avoided it, you would have missed out on 6.91%. Now, there are 3 coupon codes for a free month for each report. Jump in there, start making money. We know you can, and we're going to help you do that. Because one place that we need to see Fidelity making money is on their call about treasuries. You kind of guess where we're going with this, because if you're looking at purely the notion that the Fed controls the bond market, which is what this fund manager is suggesting, well, you got it completely wrong, because you look at 10-year Treasury yields here in blue against the federal funds rate, and what do you see? The yields lead the Fed every single time. This isn't a debate. This isn't a question. This is a matter of historical fact. So even if the Fed were to raise rates here, if indeed the bond market sees some signs that the Fed is wrong, that the economy isn't really accelerating, and there are some ways we can tell that, be sure to stay tuned to the end of the show. We got one conclusive slide on this that will make it very clear if the fund manager here at Fidelity made the right move or the wrong move. So the Fed can raise rates. And guess what? 10 and 30-year Treasury yields can absolutely fall in that case. There's no question. But he goes on to say the U.S. economy is showing more signs of reacceleration than it is slowing down. That is slightly debatable here, adding that, quote, I wouldn't be surprised in a couple of quarters down the road, we end up seeing sort of manufacturing PMI in a more expansion sort of territory. Well, I'm going to make that case. Well, that is not going to happen. He's suggesting that being in developed markets, that is just going to be a complete fallacy or fantasy, depending on which way you like to look at it, because some funds such as Jupiter Asset Management are taking a different view, opting to load up on treasuries while seeing risks of eventual hard landing after the Fed's most aggressive tightening cycle in history here in decades. The question is this fund manager at Fidelity, is he right? Is he wrong? Is he crazy? What is the story here? Because if there's hope of a manufacturing renaissance, I believe we're seeing a short-term one, transitory one, due to the Red Sea issue, slowing down, of course, global shipping times and adding costs to manufacturing overseas, turning some buyers to U.S. manufacturers. But if we look at one clear thing, and that is the constriction of credit in a debt-based economy, which is done by the banks when the short-term rates are driven higher than long-term rates. And this is critical because banks make money on the spread. They make money, they borrow at the short end, lend at the long end, make it on the spread. When it's flipped, because central bankers raise rates too high, well, they can't make money. And of course, in a debt-based economy, so it's commercial banks that can create money through new lending. But here's a catch. They also destroy money if there's not enough new loans being originated to offset all the loans being paid down or paid off. That is a problem, because that's where we're at right now. And here we can see throughout history, if we look at the general business activity for the Philly Fed manufacturing sector in red, what do we see? The net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes in blue, making it more difficult to get money, meaning less money is created in the economy. And sure enough, what do we see? When banks are on net tightening, well, it ends up leading to a crash in manufacturing activity. And this isn't just a one-time issue, it's an every time. So right now we see this little pop-up, which I think is due to the Red Sea effect. We'll look at the actual Philly Fed data here in a moment, but I believe it's not going to hold up. And the evidence, it's in the Philly Fed data itself. Let's take a look at that here in a moment, because the strategy is now more positive on stocks, he says, but very underweight duration. And that is the risk here, that if something were to cause the stock market to go down, he's got no protection in this portfolio. We've gone through a massive disinflation period, and growth seems to be okay, and labor market seems to be okay. He said, if this is where we land, this is a great place. But what if this isn't where we land? What if this is just a stair step on the way down? Let's make the case of why his bet on stocks could go heavily against him, because when you constrict the creation of credit, you ultimately have less money to go into stocks. Now, right now, what money is in the economy is just being funneled into stocks, because the belief is, just like this fund manager, the recession odds are over. There's no way there's going to be a soft landing, probably not even a no landing. We're just going to rocket higher here, and everybody is afraid. It's called FOMO, the fear of missing out, and everyone's piling into the stock market because they only see what they know, and that is stock prices are going higher, and they believe that the equity markets are best proxy for the economy. But underneath, there's no sign of truth to that at all, because when your banks are not creating enough money, you can't support asset prices. This is the issue in commercial real estate. This is going to be the issue in subprime autos, and eventually the issue in the equity markets, because look what happens when you constrict the creation of credit. Again, shown every time that blue line is above the horizontal black line, ultimately you see a decline in equity prices, shown as the Wilshire 5000 in red. Why now? Because everybody's driving into equities. They believe that is is their future of the next big bull market in stocks. But let's talk about Philly Fed because, well, underneath the covers of that headline print, things don't look so great because manufacturing activity in the region expanded overall, according to the firms responding to the February Business Outlook survey. The indicators for current general activity and shipments rose and turned positive, which is a good sign. The indicator for new orders also rose, but catch this, remained negative. In fact, the employment index suggests declines in employment overall. And both price indexes indicate overall increases in prices, but remain below their long-run averages. The broad indicators for future activity rose as well. So if you're looking for an economic expansion, well, wouldn't you expect that new orders should be rising up here as demand starts to come back and wholesalers and retailers realize that things are turning around? And you would also expect that these manufacturers would be hiring instead of firing. Here you can see new orders for the month of February in contraction at minus 5.2. Unfilled orders, this is your backlog. This is things you mean to get to when you have time. Your non-critical orders, they're still in contraction at minus 11.7. How about delivery times? They continue to be very, very quick. Inventories, again, suggesting if you see decline in delivery times, you know there isn't a lot of demand. Inventories, they're still in contraction. That should be going up as manufacturers start to build inventory. But how about this? Number of employees down. You see minus 10.3 on the report. Why is that? We've made the case. If new orders go down and the backlog goes down, eventually you don't need employees. Now the work week went up a little bit, probably to offset the number of employees that were let go, but that is about it. You look at the underlying case of this report, you do not see economic expansion, and that's why we note that the bond market here should be going down in terms of interest rates, not higher. In fact, that manager at Fidelity, he should be piling up on duration instead of unloading it. Because what we can note here is, again, back to that Philly Fed manufacturing data in red here against 10-year Treasury yields, you see downturns, and I didn't line these up on the same side just so you could see the relationship. Downturns in manufacturing matched by downturn in yield, and that tends to happen every time except now. And why does that make perfect sense? Because in a debt-based economy, what do you need to keep the economy going? You need people to consume. So when the economy slows down, how do you get people to consume in a debt-based economy that needs the creation of new debt to support growth and the payment of the existing debt? Well, do you have interest rates go up? No, they go down. They have to go down because that's the incentive that gets people to go out and buy things they don't need with money they don't have and do it today. That is indeed why we see the relationship of slowing economy, lower yields. That's why here the Fed could raise rates and the bond market could call its bluff, because around the world we see the same effect as UK consumer confidence retreats amid caution about the economy. This again putting a question mark in this decision about this Fidelity fund manager to get rid of the Treasury's position he's got. And here we can see that most measures fell on the month, including gauge of willingness to make major purchases. That doesn't sound like economic expansion, but households remain relatively upbeat about their finances in the year ahead, given the fact that perhaps they have nothing else to be hopeful at, because the reality for many households remains adapting spending. I love this, adapting spend to meet higher essential costs. Well, this is really simple. When costs go up and your wages don't, you do one thing, you don't adapt. You cut your spending. It's that simple. And when you cut your spending, you cut it on the discretionary side first, because you can't cut your housing costs. You can't cut your food costs. You can't cut your energy costs too much. You can do a little bit there, but not a whole lot. You have to cut the discretionary side. And that, of course, leads to more layoffs and less demand, as many households still face higher mortgage rates this year in the UK when their fixed term deal ends this year, suggesting that higher rates are going to cause higher service costs on their mortgages and ultimately less discretionary spending, slowing economy there in the UK. Why consumers are optimistic? Well, that is baffling, because when we see the job recruiters there report a sharp slowdown in pay for new hires, you would think that that's not too great. As their survey published Thursday found employers in cautious mood as hiring significantly fewer permanent staff and restraining pay increases amid concerns about the economic outlook and pressure on spending budgets, which again puts into the question, what is this Fidelity fund manager seeing other than his own optimism and perhaps his own bias? As we look around the world, we see continued signs of an economic slowdown. Nothing here gives us any sort of optimism that we're on a broad increase in demand and economic growth. And I looked at how pay growth and demand are influencing firms' pricing decision to assess how persistence is evolving in relation to what is embodied within our forecast, they said, and that will allow me to be more confident that inflation will return sustainably to target in the medium term. Of course it will, because when you crush demand, that means, of course, in the component of inflation, you have supply and demand. If you bring demand down and supply up, well, granted, you're going to get a lot of disinflation. It's going to take time to flow through there. And sure enough, and one of those ways is as you give out less and less pay increases, or in this case, as we look at total compensation here in the U.S. data, and we see it slowing down because average hours worked is headed down. This expressed in form of total compensation and average hourly earnings multiplied by average weekly hours of production of non-supervisory employees in red. Now we're going to get an update on this one pretty soon here as we head into the end of the month and that first Friday of next month where we get the data from the government. This is against the consumer price index. So this is really simple. If you look at the fact that as people have less and less money to spend and pricing pressure remains elevated, well, of course, demand goes down. That's how you break the economy. It all comes falling apart. But now let's talk about where I started the show is what is the one thing that this Fidelity fund manager is missing. Let's take a look at this headline first because it tells us everything. As China's yield curve nears inversion, a sign of more stimulus needed. So here we see that inversion again, that talk about how short-term rates are higher than long-term rates. And what does that mean for the bond market? Well, as you're about to find out, it means the Fidelity fund manager has got this all wrong. Because when we look at the 10-year, 2-year shown as the yield curve in red, inverted anytime below the horizontal black line, what do we note? That here you see inversions. And look above, you see 10-year treasuries. Well, what happens? Rates fall. They tend to not rise. In fact, following every inversion, you get a decline in yields. And not a little one, tend to be quite sizable declines in yield each and every time, suggesting that the bond market here knows best and that if Fidelity's fund manager here really wanted to do the right thing for his portfolio and his clients, he would have held on to those positions. But ultimately, we'll find out in time if he's right or wrong. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.